understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's has done very well as a company,
right,
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, whether, who's the president, who's being nominated for the Supreme Court,
it's all
the
earnings.
ozone layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Yeah, but what they will say to you, Peter, is that, as you know, and why am I telling you this, but they're telling you that these other things influence the amount of earnings of a particular company.
Yeah.
If we're in a recession, people are not going to spend as much money on going to the movies or whatever they do.
Right.
And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to tell
you. He can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years. He's even surprised how low they are now. So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of '82.
Yes.
In 1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. Yeah. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about
Peter Lynch's advice on how to invest in 2023. Peter Lynch is a well-known American investor, author, and philanthropist. He is best known for his role as the manager of the Fidelity Magellan Fund from 1977 to 1990, during which time he achieved an annual average return of 29.2%, making it one of the most successful mutual funds of all time. Lynch is a value investor who follows a bottom-up approach to stock picking, focusing on individual companies and their potential for growth. He is known for his belief that ordinary investors can outperform professional money managers by doing their own research and investing in companies they understand. In addition to his investment career, Lynch is also the author of several books on investing, including One Up on Wall Street and Beating the Street, which have become popular among both professional and amateur investors. He is also known for his philanthropic work, including his support for education and medical research. Peter Lynch generally believed in the power of long-term investing and held a number of stocks for many years. He also believed in the importance of diversification, suggesting that investors should spread their investments across a variety of sectors and industries to reduce risk. During times of high inflation and economic crisis like predicted in 2023, Lynch recommends the following strategies for investing. Peter Lynch's first recommendation for investing during times of high inflation and economic crisis is to look for companies with strong balance sheets. A company's balance sheet is a financial statement that provides an overview of its assets, liability, and equity. Companies with strong balance sheets typically have low levels of debt and strong cash flow, which can help them weather economic downturns and emerge stronger on the other side. Here are some examples of how his suggestions might be applied in practice. Look for companies with low debt levels. Companies with low levels of debt are less vulnerable to financial stress and are generally considered to be in a stronger financial position. For example, a company with a debt-to-equity ratio of 0.5 or lower may be considered to have a strong balance sheet. Consider companies with strong cash flow. Companies with strong cash flow have the ability to generate sufficient cash to meet their financial obligations, including debt payments and operating expenses. For example, a company with a positive net cash flow from operations may be considered to have a strong balance sheet. Look for companies with diversified revenue streams. Companies with diversified revenue streams are less reliant on any one customer or market, which can help them weather economic downturns. For example, a company that generates revenue from multiple sources, such as different product lines or geography, may be considered to have a strong balance sheet. Before going to the second recommendation, please click the subscribe button and like the video for the algorithm. Thank you. Peter Lynch's second recommendation for investing during times of high inflation and economic crisis is to consider defensive sectors. Defensive sectors are industries that tend to be less affected by economic downturns and may offer more stable returns during times of uncertainty. These sectors may include healthcare, utilities, and consumer staples, among others. Here are some examples of how this recommendation might be applied in practice. Healthcare companies, including pharmaceutical and medical device manufacturers, may be less affected by economic downturns because people continue to need medical care regardless of the state of the economy. For example, a company like Johnson & Johnson, which manufactures a wide range of healthcare products including pharmaceuticals, medical devices, and consumer health products, may be considered a defensive investment. Utility companies, including those that provide electricity, gas, and water, may also be considered defensive investments because they provide essential services that are in constant demand. For example, a company like Duke Energy, which is a leading electric and gas utility company in the United States, may be considered a defensive investment. Consumer staples are products that people tend to buy regardless of economic conditions, such as food, household items, and personal care products. Companies that produce these products may be considered defensive investment. For example, a company like Procter & Gamble, which manufactures a wide range of consumer staples products including Tide laundry detergent and Crest toothpaste, may be considered a defensive investment. Peter Lynch's third recommendation for investing during times of high inflation and economic crisis is to focus on companies with long-term growth potential. These are companies that have strong fundamental drivers, such as a strong competitive position, favorable industry trends, and a solid management team that suggests they will be able to grow and generate returns over the long term. Here are some additional examples of companies with long-term growth potential that could be considered during times of economic uncertainty. Amazon. This e-commerce giant has a strong competitive position with a large and loyal customer base and a diversified revenue stream. It has consistently delivered strong revenue and earnings growth, and its expansion into new areas such as cloud computing and advertising has opened up additional growth opportunities. Alphabet. This technology company has a strong brand and a leading position in the search engine market. It also has a diversified revenue stream, with revenue coming from advertising, cloud computing, and hardware products. Its ongoing investments in artificial intelligence and other emerging technologies suggest it has strong long-term growth potential. Nike. This athletic apparel and footwear company has a strong brand and a diverse product portfolio. It has consistently delivered strong earnings and revenue growth, and its focus on innovation and sustainability suggests it has strong long-term growth potential. Peter Lynch's fourth recommendation for investing during times of high inflation and economic crisis is to keep an eye on valuations. Valuations refer to the price of an asset relative to its underlying fundamentals, such as earnings, revenue, or cash flow. It's important to be mindful of valuation, especially during times of market volatility, as they can help investors identify opportunities for potential returns or areas of risk. Here are some ways to consider valuations when evaluating investment opportunities. Use financial ratios. Financial ratios, such as the price-to-earnings or P/E ratio or the price-to-book or P/B ratio, can help investors compare the valuation of one company to another or to a market average. For example, a company with a P/E ratio that is significantly higher than the industry average may be considered overvalued, while a company with a P/E ratio that is significantly lower may be considered undervalued. Consider the company's fundamental drivers. It's important to consider the underlying fundamentals of a company, such as its earnings, revenue, and growth prospects, when evaluating its valuation. For example, a company with strong earnings and revenue growth may justify a higher valuation, while a company with weaker fundamentals may warrant a lower valuation. Be aware of market conditions. Market conditions, such as economic growth, interest rates, and investor sentiment, can all impact valuations. It's important to consider these factors when evaluating investment opportunities, as they can affect the price of an asset. It's worth noting that valuations are just one aspect to consider when evaluating investment opportunities, and it's important to consider a range of factors, including the company's fundamentals, growth prospects, and risk profile. It's always important to conduct thorough research and carefully consider your own investment objectives and risk tolerance before making any investment decisions. As a value investor, it's important to focus on the intrinsic value of a company, which is the true worth of the company based on its underlying fundamentals, such as earnings, revenue, and growth prospects. During times of economic crisis and high inflation, it may be tempting to focus on short-term market movements or to sell off investments in anticipation of further market declines. However, as a value investor, it's important to maintain a long-term perspective and to focus on the intrinsic value of the companies you are considering investing in. Here is a general outlook from a value investor's perspective on how to approach investing during times of economic crisis and high inflation. 1. Focus on the intrinsic value of companies. As a value investor, it's important to focus on the underlying fundamentals of a company, such as its earnings, revenue, and growth prospects, rather than short-term market movements. 2. Look for companies with strong financials. Companies with strong balance sheets, including low debt levels and strong cash flow, are likely to be more resilient during economic downturns. 3. Consider defensive sectors. Some sectors, such as healthcare, utilities, and consumer staples tend to be less affected by economic downturns and may offer more stable returns during times of uncertainty. 4. Focus on long-term growth potential. 5. Keep an eye on valuations. With that said, guys, please subscribe to this channel, like the video, and click the video popping up. See you there.